we try to the American companies, our experts in America, they advise them how to set up the units there, how to find the units there, what are the challenges which they may face, and also we sort out the ongoing problems also which are happening between both this as well as economic issues concerned. Today, if someone asks me why is Trump behaving like this, I don't know. So any economic related issues, we try to sort it out. Out of it. That is one. Indo-American Chamber of Commerce also is an advisory, is also an advisory. In fact, we advise state government on their policy related issues, in fact. We try to guide them, tax regulations, how it will be friendly with both the companies, both the countries. So with this, I don't want to talk much, but with this, I wish this product to be a very fruitful session. I know this topic, your interesting topic, definitely. You have a lot of queries. So my suggestion is that let's jot down the query photo we have got. Once the session is over, we will just leave the house for discussion. Then you can raise your queries. Right? What do you say? We want to go there? Okay. Just give a chair there.
Why is that people when you join me on? It's not
Yours just So good afternoon, everyone. So thank you, sir, for the warm welcome. So we'll go into the session directly. Yes. So the main objective of the session is to understand the implications and the procedures under the FEMA and income tax, and we are limiting any amount from India to outside India. So within the limited time, we'll try to cover the key important topics, which are mostly required for individuals and corporates, but remitting the amount from India to outside India. So though there are a lot of regulations under the FEMA and income tax, we'll not go into in detail of each and every line or each and every topic. So considering the time limit, we'll touch upon the important things and we'll see the practical scenarios, how we should react when we remit amount from India to outside. So we'll start with FEMA first, then we'll see the income tax also. So in this session, we'll cover 3 types of remittances. One, a remittance by a resident individual. When a resident individual wants to transfer any amount from India to outside India. So what is the procedure under the FEMA? The simultaneous procedure or implications on the income tax.
Sorry, sir, I had
Yeah,
I'll see if my
number. I'll give my card.
You can come to the center also. In fact, I don't think you can.
That is recording, it's in there.
Yeah.
Oh.
Recording. They're recording the session.
Recording is going.
Fine, sir, we'll continue. We'll see if we can.
I'll try to
Yeah.
speak louder, no problem.
Members say you can come.
No problem, sir. I'll try.
Come to the center, in fact. Take a. For recording, just turn this and you come to the center.
So there are 3 types of remittances going to cover here. One is the remittance by resident individual. So another one is the remittance by non-resident individual. When you are residing outside India and wants to remit in amount from India to outside. So what are the implications? And third one is the remittance are payment by corporate. When a corporate company is paying or corporate entity is paying amount to outside India for various purposes, business purpose, investment purpose. What are the income tax implications? And also FEMA process need to be followed. So we'll discuss in detail. So This one is just introduction. So we will remit amount for various purposes. Travel purpose, education purpose, donations, investments, or import of goods or services. So how to deal with income tax and economy?
Will this presentation be available to all?
Yes, we'll share.
Yeah.
We will share it.
So before going to discuss with the remittances, we need to understand the resident status under the income tax, and because residential status under the income tax is different and the under FEMA is also different. So both are independent, needs to be considered. What is the resident status under income tax for individual companies, firms, LLP, whatever else. In the same wise, residential status for the companies, individuals under the FEMA also. Because a person may become a resident in India under the income tax act, maybe become non-resident under the FEMA. When we are remitting amount from India to outside India, the questions may arise whether TDS needs to be deducted on some sections. There is a TCS also which needs to be collected by the banks. Whether there is any conflict between TDS and TCS, both will apply simultaneously, and both are mutually exclusive, we need to discuss. So resident status is the most important thing under the income tax. First we'll discuss the resident status. Once it is done, then we'll go into the remittances. So this one is the resident status under the FEMA. It says that a person is considered, it is for the individuals. A person is considered as resident in India under the FEMA based on his number of days of stay in India in the preceding year. It says that if he resides in India more than 180 days in the preceding year, then you are a resident for the current year. Under this FEMA. This one is under FEMA. So if we are considering the resident status for the year 24-25, and as we have 25-26, we need to calculate the number of days stay in India during the preceding year. And there is an exception which says that if you are leaving India for the purpose of employment or business purpose or for a period which is uncertain, automatically will become non-resident, irrespective of number of days stay in India during the preceding year. For example, number of days in the preceding year is 150 days or less than 100 days. But if you are leaving India for the purpose of employment, you will become a non-resident. Simultaneously, when a person is coming to India from outside India, he will become resident in India if he comes for employment, business purpose, or any other purpose which is uncertain.
That's also dependent on the time sheet, correct?
There is a controversy between a person coming to India now, that is not. It says that if you see this definition of the resident, it says that individual who is resident in India for more than 180 days in the preceding year, but does not include. This is a negative sentence. There is one more negative sentence which says that otherwise than. There is one opinion or one view states that 180 days need not be considered when we are coming to India. Once you come to India for employment, you will become resident. There is one more view which says that you need to satisfy 182 days plus you have to come to India for the purpose of employment. But if you are leaving India for the purpose of employment, irrespective of number of days in the preceding year, will become non-resident.
You cover that a little bit more in detail later.
No, this is what we are. You have any doubt?
I'll ask you.
Yes, please. Let's note down, madam, then we can
Correct.
ask.
So this one is for the purpose other than individuals. Where a company or a firm or any other entity which is registered in India will become a resident in India. So this is the resident status under the. So once you become a non-resident or non-resident, you need to check with the resident status in the income tax also. So just because you become a non-resident under FEMA, you will not become non-resident under income tax also. We need to check the resident status in the income tax also. Because the taxation will come based on the resident status under the income tax act, whereas the remittance will come under the FEMA based on the resident status under the foreign income. Both are different. We need to check both. So this one is the resident status under the Income Tax Act. Section 6 of the Income Tax Act defines the resident status for each and every person, being individual, company, or firm, or LLP, or any other person. So we'll discuss individual status first. So if there is any conflict between the Section 6 and the FEMA, we need to check both. Both are different, independent, so we need to check both of them. So it states that if you are a resident in India or you stay in India for the current year more than 182 days, so you will become a resident in India. Under the FEMA, we need to check the previous year, whereas on the income tax, we need to check the current financial year. So if you are residing in India for more than 182 days, then you will become a resident in India. This is the condition number 1. The second condition is if you stay in India more than 60 days plus 364 days preceding 4 years, then you will become a resident. If you satisfy any of the conditions, any of the 2 conditions, which means 182 days or 60 plus 364. So you will become a resident in India. But there is an exception. It says regarding a person who is going to outside India for the purpose of employment. So that 180 days, if you are going to outside India for the purpose of employment, we need to check 180 days condition only. There is no concept of 60 plus 364 days. So only if you are residing in India for the current year, more than 182 days, and you are living in India for the purpose of employment, then you will become a resident in India. Otherwise, you will become non-resident. So here the word for the purpose of employment makes some disturbance, because what is the purpose of employment also a debatable issue. So a person may go to USA to seek a job. He doesn't get any job when he was in India. He went to US to apply a job and he got a job. Whether that is sufficient to tell it is for the purpose of employment. The second condition is he already got a job, then he went to USA. That is the second scenario. The third one is he is residing in India. His employment is in India. He went to USA on a deputation basis. Whether that is also for the purpose of employment. The fourth one, a person being a sole proprietor went to India for self-employment. Whether that is also for the purpose of employment. So there are 4 types of scenarios. So this is not explicitly defined under the Income Tax Act. But courts have held that for the purpose of employment is a broader term, which includes 4 scenarios which I covered. Whether it is for employment to get an employment outside India, or to went to outside India on a deputation basis, or it is for self-employment purpose. So all scenarios will cover for the purpose of employment. So automatically, if you are residing in India only more than 182 days, then you will become a resident. Otherwise, you will become non-resident. Even if the stay is more than 60 days and 364 days in the preceding 4 years, you will become a non-resident. This is a catch here. So we might be knowing that government is bringing new income tax act next year. So there is a couple of amendments also will come. The word for the purpose of employment is going to change. So because there is not it is not intention of the government to give relief to 4 scenarios, but courts have interpreted like that. So now draft bill already made the changes, interpreted the changes, stating that not for the purpose of employment, only for employment. And the purposes have been removed. So once the bill becomes active, only those persons who went to outside India for employment will become non-resident. Otherwise, he will become a resident if he resides in India even more than 60 days. So this is just explains the sections how the resident status works. What type of income is taxable in India if he is a resident in India and if you are non-resident. If you are resident in India, then automatically your global income is taxable in India. So because if you are residing in India and you are earning income from US, UK, UAE, Australia, every income is taxable in India. Though that income is maybe or may not be taxable in other. How it works, we'll discuss later. This one is other than individuals. If you are a company registered in India, you will become resident in India. Or the place of effective management is India, then automatically it is a resident.
Just for the benefit of members, we'll be sharing the PPT for you. So in case if your taking pictures not required, we will share.
So this is the broad difference between the FEMA and the income tax when it comes to resident status. So we need to, under the FEMA, it says the section says that number of days resides in India, whereas the income tax has the number of days stay in India. The difference between the FEMA and income tax is FEMA uses the word resides in India for the purpose of determining the resident status, whereas the income tax uses the word stay in India. The logic is FEMA talks about the intention of staying, intention of the person to stay in India. That is why if you are leaving India for the purpose of employment, your intention is to leave India, automatically you will become non-resident. Whereas the income tax acts number of days of stay, what is the intention behind the stay doesn't matter, you will become a resident in India. So that's why the difference between the income tax and FEMA is, if you use the word residence, resides in India, income tax uses the word stay in India. Threshold is 180 days during the previous financial year under the FEMA, whereas under the Income Tax Act it is 182 days or 60 days. Sometimes it is 120 days also will come. So when you are earning income from outside India, in India of more than 15 lakhs, and your stay is more than 120 days, you will become a resident in India. So we'll go into the full session on the remittances. We'll start with FEMA first. So we know that there is capital account transactions and current account transactions. We'll not go into depth of each and every type of transactions, whether it's capital account or current account. We'll go into the only brief of the capital account and current account transactions. So capital account transaction is nothing but a transaction related to the exceptional liabilities. That is what in a simple terms. So if you're a person residing in India and you are transacting with an asset or liability outside India, it will become a capital account transaction. Similarly, if you are residing outside India and you are transacting with an asset or liability in India, that is a capital account transaction. And current account transaction is nothing but other than the any capital account. So these are the three types of remittance we're going to discuss today. Though there are other remittances will be there, but we'll not touch because we are focusing on only these three types of remittance. One is by resident individual, another one is the non-resident individuals and the non-resident corporates, and the third one is the resident corporate remittance. So when you are a non-resident, NRI or person of Indian origin wants to remit amount from India to outside India, there is specific regulations. It is called as remittance of asset regulations under the FEMA. And if you are a resident in individual and wants to remit outside India, there is a separate set of regulations which is called as liberalized remittance scheme. This is also under the FEMA. And the third one is when you are a company or corporate or the business entity wants to remit for the import of goods and services, there is one more regulations for import of goods and services. So these three topics only we'll go into discuss. First, we are going to discuss the remittance of asset regulations under the FEMA and the income tax implications also will discuss. So, for example, there is a person residing outside India, being non-resident individual, for example, NRI, most commonly known as, or person of resident in Indian origin, residing in USA, holding immutable property in India. After 10 years or 15 years of his holding, he wants to transfer that property and remit that amount from India to outside India. The question arises whether this can be allowed. If it is allowed, is there any limit? Then income tax implications. What is the process to be followed? Any TDS implications or TDS implications? So these are the questions that we have. Generally, an individual may have. So we'll discuss the remittances by a non-resident first. Non-resident individual or a company using the remittance of asset regulations. This regulation has been brought in order to allow the non-resident to remit an amount of $1 million per year. The maximum limit is $1 million.
which is approximately 82 rupees per financial year. So under these regulations, a person can remit up to $1 million for these specified remittances under this scheme. So who are the persons covered? What type of remittances covered also we'll discuss. So persons covered under the scheme is a foreign citizen, a non-resident individual or NRI, or a person of Indian origin, Indian entity, Indian company, branch or license office in India. This one first scenarios, a foreign citizen wants to remit outside India. What are the conditions? What are the processes to be followed? A foreign citizen came to India for employment purposes. After the retirement, he wants to remit that amount. He can remit up to $1 million per financial year. So other than this purpose, a foreign citizen cannot remit India from outside India. And if any student comes to India for training or education purposes, and brought amount from outside India to India, when he is leaving India, he can take that amount that is lying in his bank account outside under this scheme. When a foreign company set up any branch or license office, and at the time of closing of that branch or license office, it can remit amount to outside India. Same Indian entity or Indian company having any employee outside India. For example, a company incorporated in India having an employee, we come to India on a deputation basis, but his social security is licensed with the USA, for example, PF amount or pension. They want to remit out to outside India, they can remit under this scheme. So this is the most important thing, NRI and the person of Indian origin. So what is the maximum amount that is allowed? What is the purposes? So we'll start with an practical scenario. So we'll take one example. Mr. A is an individual, is residing in India from his birth. He went to USA for his studies. He has completed his studies and joined in a company in USA. 10 years, he wants to sell one property which has received from his father or ancestral persons. After selling his property, he wants to remit amount to USA. So the question arises is whether TDS is applicable and any limit is there for the remittance. So we need to check the FEMA first, then the income tax will go. FEMA says that once you become a non-resident under the FEMA, you need to designate your bank account from normal savings account to NRO account. Then only you can remit under this scheme. If you are still holding normal savings account and go to bank and submit form A2 or something else, they will not remit the amount under the remittance certificate. Because remittance, in order to remit the amount from this under this scheme, we need to have the NRO account. Then only they will remit the amount from NRO account to outside India. So once you want to sell the property, or once you become a non-resident, the first thing one need to do is you need to go to bank, you need to submit the declaration, asking the bank to convert or redesignate your bank account from normal saving account to NRO account. Once the bank account changes from normal savings account to NRO account, then automatically you can send amount from this saving NRO account to outside India up to 1 million per year. So it says that an NRI or a person of Indian origin, out of balance held in NRO account, sale proceeds of assets acquired from by way of inheritance, he can remit to outside India the maximum of $1 million per year. If you want to remit more than 1 million, you need to go to RBI and get the permission. The condition under the scheme is while you are remitting to outside India, that the amount should be your own. That is not borrowed funds. You should not borrow from your friend or relative and remit outside. It is not allowed. And you should not transfer from one NRO account to another NRO account to remit outside. Because the maximum limit is 1 million. So I can transfer my 1 million through my NRO account. I can send my another million to my friends or family members and things. That is not allowed. So remittance from one NR account to other NR account is also not allowed. The last condition is after the liquidation of companies in India, which is set up by the current company in USA, they can remit the amount from India to outside India. So now we discuss the remittance of asset regulations. We'll see some other questions also. Are the practical scenarios, or what are the other conditions where remittance of asset regulations is not applicable, or the limit under the remittance of asset regulations is not applicable, but $1 million. So popularly known as $1 million in these regulations. So one person, earlier we discussed one scenario of resident become non-resident and renting from outside India to outside India. The same scenario, he left India for the purpose of his job. He became non-resident in India under the FEMA. And after 10 years, he remitted 1 crore rupees from outside India to India to invest in a property in India. Now, after selling this property, he wants to remit outside India. So, under this scheme, $1 million scheme, only if you're remitting from India to outside India, the $1 million scheme is applicable. But the amount for the purpose of investment in India, if you bring that amount from outside India, then the scheme is not not eligible. So you can remit without any limit. Which means that this scheme has been brought in order to safeguard our interest. Means the investment of money, base investment money is from India, then we cannot remit more than 1 million. The base investment money or the original investment has come from outside India. Then without any limit you can transfer. That is the law.
So that is irrespective of the age.
Irrespective of it, you need to pay the tax and you can remit.
So you bought 1 million.
You got 10 crore rupees to India, sir. You invested in a property. After 10 years, you got 100 crores. You can remit outside India. But there is no limit. But you need to pay tax. For that purpose, you need to pay the consideration through NRE account or FCNRI account or through directly to in foreign currency. Should not bring that amount to NRO account. You should not pay. If you pay the amount from NRO account for the purpose of acquisition of any property, automatically the limit will apply at the time of sale. You're making the payment from.
I'm sorry, I didn't understand. Is that you're talking about remitting to India or from India?
No.
That's the limit, again, please, thanks.
So when you are remitting amount from outside India for the purpose of acquisition, there is no limit. You can bring how many dollars you want to bring, and there is no limits for remote remittances under the FEMA. You can bring 10 crores, 100 crores, 1,000 crores for making investment. Subject to FDA regulations, if you are making any investment in the company. For the purpose of investment in immovable property, you can bring money and you can invest in immovable property. Subject to there are conditions also. A foreign citizen cannot hold immovable property in India. A non-resident can invest. Foreign citizen cannot hold. NRI or OCA can hold immovable property in India. That is also agricultural land should not hold. Or plantation, farmlands should not hold. Only normal.
PIO can hold.
Yeah. Now it is OCA. The PO concept admitted less with 2%. So if the amount has come from outside India without any limit, you can remit to outside India. If your property they acquired from ancestral property or inherent or by gift, then there is $1 million. There's a logic. Don't try to remember this whether it's gift. The logic is the amount has come from India, foreign exchange come to India. Then you can freely bring out that. If the foreign exchange has not come to India, then automatically this will not. In order to safeguard that forex reserves, there is a limit. Now we're going to discuss the LR scheme. So resident individuals, citizens like us, wants to remit to outside India. So what is the maximum limit? For what are the conditions? For what purposes we can remit? And any form needs to be filed or anything needs to be discussed now. So this will discuss FEMA first. Automatically we'll go to the income tax also. We are not discussing income tax at presently because we'll close FEMA for the three types of remittance. Then we'll go to income tax. We'll discuss income tax for the three types of remittances. LRS is applicable only for resident individual. Whereas the remittance of resident individuals, we are seeing individuals or foreign citizens, Indian company, Indian entity, license office, bank office. But whereas LRS is applicable only for individuals, that too only for residents. Who has resident in India under the Foreign Exchange Management Act is individual, then only LRS scheme is on. If corporate wants to remit outside India, then the separate regulations are applicable. Only this one is only for the resident individuals. It can be for the capital account transactions and the current account transactions, or both. There are some restrictions under the FEMA for transferring to outside India for certain capital account transactions or certain current account transactions. We are not going to discuss in detail. Briefly, I can tell that if it is for the purpose of investment in media companies, investment real estate, investment in chit fund companies, that is not allowed. The maximum limit is $2.5 million under the LR scheme. Whereas under the remittance of except regulations, by non-resident is they can remit up to $1 million. Whereas the LR scheme, they can remit up to $2.5 million, which is approximately 2.5, which is equivalent to 2 crores.
Please go over the exemptions. What are you not allowed to invest in this money? You just said, right?
I'll that is there, I'll say. No.
Thanks.
So an individual can remit up to $2.5 lakh per year. These are the permissible capital account transactions: opening a foreign account abroad, foreign currency account abroad, purchase of property abroad, can remit to outside India for the purpose of purchase of property. Should not realize investment in real estate business. The third one is overseas direct investment or overseas portfolio investment. Previously, there was a lot of confusions for investment by individual in overseas market. 3 years back, they regularized or they redrafted the regulations for investment by a resident individual in a securities outside. So that's where the overseas direct investment and portfolio investments have come. For example, now everyone is investing in shares of Apple, Google, are located outside there. 3 years back, it is some doubts are there, some questions are there. Now it is allowed. Previously also it is allowed, but it's subject to filing of some documentation. Now it is freely allowed. Then extending loans to NRIs who are relatives. This one is the permissible capital account transaction. Now, resident individual wants to remit to outside India up to 2 crore rupees. He wants to give a loan to his friend who is located in USA, for example. So that is allowed or not. So, if he wants to give loan to any person outside India, we need to check whether he comes under our relative definition or not. He cannot give loans to every person to outside India. If he becomes your relative, then only can give a loan. That's to maximum of 2.5. If you want to give loan in rupee to your relative, there are set of types of conditions are applicable. That loan should not be more than 2.5. That is there, and that amount should not be remitted to outside India. For example, you want to give 2 crore rupees to your brother or your son, your daughter in Indian rupees. They cannot use that amount for the purpose of remittance to outside India. They can use their own purposes in India. If it is Indian rupee loan, it should be interest free, and its minimum maturity period should be less more than 1 year.
So if that loan is given in India, how will it be remitted to through Indonesia? Last point,
Sorry,
the last point. If the amount is given to the loan shall be credited to an NRO account and loan shall be remitted.
that's what I'm telling
Not
you.
be but then the last point says the repayment of such loan should be made by
When you are giving the loan, should not remit outside India. But if your relative wants to repay that amount,
how will it inward remittance? It cannot be inward remittance, it's only a transfer.
it is an inward remit. He has to bring amount from outside India, then he will pay it.
Then how, if he's sitting in America and I'm sending money to him in India in NRO account, how will that money go outside if it's not getting remitted outside India?
He is not remitting, sir. He is using for his personal purposes in India. Should use only for the personal purpose in India.
Oh, it's a rupee loan,
It is only rupee loan.
not dog.
Rupee loan, yeah, but he will not earn rupees. If you are saying that he should spend, how the government is saying that I will dictate even how you will spend your money also.
In order to preserve the foreign currency, sir. That is the purpose here. The FEMA comes only for to preserve the foreign exchange. So these are the permissible current account transactions. When you are going to private visits, you can use this LR scheme. Or if you want to give any gift to your person, then you can use it. Employment or maintenance of your family or education, medical treatment, everything only under this scheme. But the question arises, if that amount is not sufficient for medical treatment, for example, what should we do? The cost of the treatment is more than 2 crore. What should we do? Should go to the government and then get the permission for remitting more than 2 crore rupees or 2.5 lakh. A business trip. If he wants to go to any other country for a business trip, the question arises whether the amount is paid by you directly or by your company. The company is paying the amount, then the scheme is not applicable. Normal regulations are applicable. They can remit without any limit. But if you are on your own funds, you are spending that amount, then the scheme is applicable. Then the maximum limit is $2.5.
It's called some automatic route and some.
It is not that, sir. Automatic route you're talking about when the outside amount is coming for investment in automatic route or the upload route.
For sending money outside India, that is also under automatic.
Now that is what this one is, that, sir. Maximum 2.5 for a resident.
And that is for more than 2 crores, you have to take permission from RBI.
That will not be given, sir.
Declaration.
No, that will not be given. That you are talking about the $1 million. We are limiting more.
No,
We are not
for the
NRI.
treatment, for the
Treatment that is allowed. Yes. Treatment up to $2.5 you can remit. Beyond that, you need to get the estimation from the hospital outside India. First of all, then you can go to AD bank, then you can apply. So medical treatment or for education, these two are allowed more than $2.5. Subject to condition that you need to get the estimation first, then you can remit the amount. There is a detailed article written by our office. You can read out. I have given the link also. You can download. We're asking for the probate transaction system. That article contains detailed list.
Sir, please explain the last point. Sir. Bank shall provide, not provide any credit facility.
That is what I'm telling, sir. For the purpose of, if you want to remit India under the LR scheme, for purpose of investment in a shares, immovable property outside India, that should not be a loan fund. Your own fund, you should investment outside India. You should not borrow amount from the bank and.
Suppose I'm having one property which is say 1 crore rupees, and I'm pledging it for I'm taking secured loan. Then I cannot transfer that money out.
Yes. For the capital account transactions.
That's not capital account, it doesn't form under current accounts. Capital account transaction only when you want to send money. Not
Purpose,
permitted.
what is the purpose you're saying?
Or if you want to buy an asset, I'm having an asset, but I want to slowly dispose of this, but I want to create an asset in abroad.
That is not allowed, sir, because that you are dealing with the forex speculative market.
It's not speculation, it is capital account investment.
That is what, that is the, that is not in your hand. The investment outside India is not regulated by the government.
I am permitted to invest my money anywhere. I'm getting money here. I'm permitted to send money abroad. But then I must be able to freely invest it also. This is my asset. The asset belongs to me. I can pledge it to the bank.
If the asset, something happens to that asset, Who's the loser? The banker in India.
But he's having the guarantee,
Another can please go ahead with it. You can take the police.
The third type of transaction is remittances. Remittance by a corporate or the business purposes for the import of goods and services. So type of remittances, you can import any good, whether it is capital good or normal machinery. Okay. You can import any services, you can make the payment for royalties, you can make the payment for services like fees for technical services. Or you can make the payment for the reimbursement of excess. For example, your parent company has spent some XYZ amount and the 10% of the amount belongs to you. Then you can make the remittance to outside India as a reimbursement of expense to your parent company. So this also one of the type of remittance. But this remittance or these type of remittances are not covered under the LRS scheme or the remittance of expectations. These are not, these are the remittance covered under the import of goods and services. So there is RBI master direction deals with the import of goods and services. So there is only 2-3 conditions which needs to be checked. We need to make the payment within 6 months. That is for sure. Once we import any good or services, we need to make the payment or clear the payment within 6 months. Can make the advance payment also subject to conditions. So this is the 6 months time and this is the procedure followed for the import of goods and services. Now we'll see the income tax act because we'll go in depth under the income tax for each and every type of remittances. We have seen the remittance by non-resident first under the FEMA, and the remittance by resident individual to outside India, and the remittance by a company or business entity in India to outside India. So we have seen the FEMA, the procedure or the restrictions or the maximum amount for the purposes we have seen. Now we will see the taxation implications on the income tax side. So before starting this one, we have already discussed the resident status. So please remember, we need to check the resident status in the Income Tax Act and the FEMA simultaneously and independently. Once you clear the resident status under the both statutes, we need to jump into the FEMA, whether it comes under the remittance of asset regulations or the LR scheme or the any other third regulation. Then we move to the Income Tax Act. So we'll take the first step. Remittance by non-resident. So which means that a person resident in India making payment a non-resident. So what are the income tax implications? We'll see. We have seen that the maximum limit you can take out of is $1 million. That is what we discussed. If the amount has come from outside India, there is no limit for remittances. And if you want to remit to outside India, you need to pay income tax in India. So we have discussed that if we transfer any property in India or any immovable property, any shares or any securities, and wants to remit that amount outside India, we need to pay the taxes in India first. There is any gain, we need to pay tax. So what type of tax we need to pay? What is the procedure? What are the rate of tax? Then we'll see that. So there is a section 195 under the Income Tax Act, which deals with the withholding of taxes when you are making any payment to outside non-resident or a foreign company. For example, I paying to a person residing outside India of 1 crore rupees. Then I need to check, being an individual also I need to check whether that amount that I'm making payment outside India, whether that amount is taxable in the hands of the recipient in India or not. If that amount is taxable in India, I need to withhold the tax based on the rates under section 195. The remaining amount only I need to pay. For example, I am paying that to a non-resident NRI because he is transferring his immovable property to me for a purpose for a purchase consideration of 2 crore rupees, for example. Now I need to pay him 2 crore rupees. I am making 2 crore rupees to a non-resident. That is allowed under the $1 million scheme. Maximum limit is $1 million. As I can make the payment, he can remit to outside India. But before I am making the payment, I need to check under the Income Tax Act whether that income is taxable in India or not. I am making 2 crore rupees
how much income is taxable in India. I'm making 2 crore rupees, but 2 crore rupees may not be taxable in India because he might have acquired that property for 1 crore rupees or 50 lakh rupees. Only 1 crore rupees or 1 crore 50 lakh rupees only taxable in India. So how to determine the tax liability and what is the rate of tax also we need to check. And if it is for the purpose of capital transfer of blue property, for example, capital gains arises of 1 crore rupees. But I don't know, being a payer, what is the gain? I don't know because I am not the person who incurred the purchase consideration, or he might have made some improvements or extra cost he might have incurred for the development of the property or like that. Then how should the individual should know how much he should deduct the tax and what is the rate? This is section 195 of the income tax deals with all these scenarios. If you are making to non-resident India and that income is taxable in India, automatically you need to pay tax or they deduct the tax at the rate of so and so, so and so, so and so it is. If it is a long-term capital gain, we need to deduct the tax at the rate of 12.5%. Long-term capital gains means any asset hold more than 24 months, it will become long-term capital asset. So we need to withhold the tax at the rate of 12.5% plus applicable surcharge and cess. If it is short-term capital gain, we need to deduct the tax at the rate of 30% plus applicable surcharge and cess. So, but being a payer, I don't know how much should I deduct because 2 crore into 12% I cannot deduct. The gain may be 1 crore or 50 lakhs, maybe there may be a zero gain also. There is a provision under the income tax. It facilitates the recipient and the payer also to visit the income tax authorities to submit a form. They need to determine the income which is taxable in India. They will prepare a computation. They will arrive at the exact amount of income liable to tax in India. They will give this amount you need to deduct. But we need to apply to the department and get the certificate. Otherwise, we need to deduct the tax on the gross amount of 2 crore rupees at 12.5 to 12.5% or 30%. So the second also, import of goods and service also we discussed. If a person residing in India, being individual or corporate company or any business entity, wants to pay for import of goods. For example, capital goods they are importing. For example, we are importing a machinery of 100 crore rupees. The question arises whether that amount, whether we need to pay any tax, any debt, whether we need to deduct any tax or not. So we need to check again under section 195 whether the amount is taxable in India or not. If that amount is taxable in India, in the hands of the recipient, then only we need to deduct the tax. If that amount is not taxable in India, then we need not to deduct tax. So how to determine that income is taxable in India or not? So we need to check a lot of conditions, whether the person is having any business in India, business connection in India, or is having any branch in India, or where he is delivering the goods, whether he is delivering the goods at your business location or is delivering the goods at their location, where the ownership is transferring in India or outside India. When it comes to services, where he is providing services, whether he is coming to India to provide services or he is providing services from outside India. And also when he is providing services, whether he is having any fixed base in India for providing those services or not. So these are various scenarios which needs to be considered for dealing with the withholding taxes. Simultaneously, there is a concept called double taxation avoidance agreements. So because that income, for example, a non-resident residing outside India, for example, there is a business entity in USA which is providing consultancy services to our company residing in Hyderabad, for example. So now we are making the payment of 1 crore rupees. We need to check whether that amount is taxable in India. Then only we need to deduct the tax. If that amount is not taxable in India, then we need to deduct it. Say, for example, that amount is taxable in India. Being a person, we are making the payment. But that person is located in USA. Considering the resident status in USA or citizenship status in USA, that income is also taxable in USA. He needs to pay the taxes in USA and he needs to pay the tax in India. So there is a double taxation. In order to avoid this double taxation, the government of India has entered into double taxation avoidance agreements with various countries, more than 100 countries. So there is a DTAA, double taxation avoidance agreement with India and USA. It provides taxation for each and every type of transaction So for example, capital gains provides separate set of conditions. Royalties, separate conditions, dividend conditions, capital gains, everything. So when we are making payment to a non-resident, and we already arrived that this income is taxable in India, and we need to withhold the tax. Or we need to deduct the tax at the rate of 12.5%, or 20%, or 30%, depending upon the nature of payment. Once we decided to deduct the tax, we need to collect the PAN number from the recipient. If it doesn't have a PAN number, we need to deduct tax at the rate of 20% straight away. There is an exception because a person may be residing outside India, or if maybe a foreign citizen. If there is no need to him to apply PAN card in India, because he doesn't have any connection in India. Just provided one service to you, which is a fees for technical services. Just because you are provided service to you, you need not apply PAN in India. There are certain exceptions if it is for the dividend transaction, interest payment, royalty payment, capital gain transaction. These 4 type of transaction, there is no concept of PAN. You need to deduct the tax under the normal provisions. Need not to deduct at the higher rate of 20%. No, not 1%. Normal rate. Normal rate means the applicable rate applicable to that. And you are remitting. The second one is you are remitting under the LR scheme. So if you are remitting to outside India under the LR scheme, the TCS will be applicable. TCS at the rate of will discuss the rates 5%, 20%, 0 rate, and conditions are also applicable.
Can you please go, what is TDS and TCS? and
TDS.
Tax deductible at source is TDS. What is
TDS is nothing but TDS or withholding tax is nothing but the payer will deduct the tax. Payer, I being the payer, when making payment to non-resident, will deduct or withhold certain portion of tax, which is considered as or called as TDS, tax deducted at source. When
Correct.
making the payment from our source, it is deducted at source because so I am the person paying the money to the non-resident. I will deduct it. TCS means when I am collecting the amount from the other person, I will collect extra amount. That is the TCS, tax collected at source.
So, when you are saying that there's a $1 million.
Yes. $1 million will not come under the TCS purview, it will come under the TDS purview.
So is it 1 million plus TDS? Or is it,
No, TDS I'm deducting, ma'am. When I'm making the payment of 1 crore rupees a non-resident,
right,
I'll deduct and remaining only I'll pay the payment.
got it. So it's minus.
Yes.
Yeah.
Now you can remit $1 million without considering the TDS. TDS will come under the income tax act. $1 million or the 2.5 lakh will come under the foreign exchange management. Both are different. This one is talking about the amount you can remit outside India. This one is talking about the taxation in India. Both are different. FEMA is to regulate or regularize the foreign exchange reserves or foreign exchange in India. Whereas the income tax is to collect the taxes in India. Both are different. Whether income tax says that whatever the amount you earn, whether it is illegal, illegal, whatever it is, I don't mind. You pay my taxes. But whereas in FEMA says that don't pay it, don't remit, don't bring, don't do this type of things only. That is why the FEMA is.
Cross it up and pay the money.
Yes, sir. So, for example, you are a non-resident, I'm a resident, I need to pay 2 crore rupees to you for purchase of immovable property. I'll deduct 12.5% and 2 crore rupees. For example, because you have not provided any certification from the department, I need to pay 12.5% right away and 2 crore rupees. You left with 1.7 crores. You can bring it. You can take to outside India without anything. I mean, up to 1.5, $1 million. Up to $1 million.
One of the things, the PAN card thing that you just said, right?
Yes.
The person who has a PAN card. So when you're paying to that person, how does the TCS change? Or the TDS? Is it TDS, right?
It's a TDS. When you are
TDS
making,
because, yeah,
when I'm resident individual making payment to non-resident,
who has
FEMA-
PAN card?
FEMA is already done, ma'am. FEMA is already completed. It is only procedural aspect and the maximum amount which can be allowed for remittance. The income tax act is for the collecting the taxes,
Right.
not for the remittance. You remit outside India or you pay in India, whatever, it doesn't matter under the income tax. You just pay my taxes and do whatever you want to do. Under FEMA, forget about the income tax act. Under FEMA, it is only for the procedural aspect. Maximum amount is $1 million I can remit. For example, a non-resident residing in the USA sold sold property of 50 crore rupees, for example. And I am the buyer. I need to check my income, whether I need to deduct any tax or not, TDS or withholding taxes, it called as. I will withhold of tax of 10%, for example. I will give him 45 crores to in his NRO account. Once I debit that amount from my account and create to his NRO account of 45 crore, he can remit up to 8 crore in the financial year. Next year also he can remit another 8 crore. Next year also he can remit another 8 crore rupees.
I think the question is about the 20%. You know, if it's a PAN card holder.
If he doesn't have PAN card, instead of
has
deducting
PAN
12 if he doesn't have PAN card, instead of deducting 12.5%, I need to deduct 20%.
Correct.
If he submits PAN card to me or PAN number to me, I'll deduct only 12.5%.
Thank you.
When he deducts 8 crores per year, balance he can take RBI permission and take. Do they give permissions easily?
They will not give central, sir.
That's okay, understood.
There is a provision, but they will not
Understood.
cancel it.
Case a non-resident company is giving any service in India. And we are transferring the amount, then also the 1 million.
No, that is not applicable, ma'am. That's what I discussed. So $1 million scheme is applicable only for this set of remittances by foreign citizen or foreign citizen who has come to for studies, or a non-resident individual or person of Indian origin, or a branch office or license office at the time of closure by Indian liquidation. Only those type of. So the remittances that I already discussed, import of goods and service master direction I have touched already. So when you are resident individual and remit to outside India for various purposes, whether it's education purpose or the tourism purpose or the donation, medical purposes, $2.5 is maximum limit, and the TCS will come now. We already discussed the FEMA, maximum amount we discussed. Now the Income Tax Act we need to discuss. 206C1G is the section under the Income Tax Act, which deals with the collection of tax at source. So we'll discuss. We were asking what is the difference between TDS and TCS. TDS is nothing but a payment deducted by the payer, whereas the TCS is payment collected by the collector, the recipient. The recipient who is collecting the amount or taking the amount from the buyer or the payer, he needs to collect the extra amount and pay the government. So if we want to transfer any amount of, for example, I am remitting of 1 crore rupees to outside India for education purposes. So I can remit under the LRC because it is within the limit of 2 crore rupees. Now the TCS also will come. So TCS under the Income Tax Act, who needs to collect and to whom it has to be paid. 206C1G incorporated recently 4 years back only. Before that it is not there. In 2021 only they have incorporated, and every year they are making changes and they are increasing the reducing the limits, and the rates also they are changing from 1%, 0.5% to 20%, 5%. We'll discuss the present rate, existing rates we'll discuss.
The banks only are collecting the TCS,
No.
there's no auto.
This collecting, sir, there is other persons also covered here. We'll discuss that also. So this we already discussed them. I have given the in the presentation also. This one also I gave. PAN card is not submitted. What are the conditions? This one is the 206C1G, which states that a banker, AD banker, or the seller of overseas tour package. These two persons are the persons who need to collect the tax when we are remitting under the LRC.
Say that again, which two persons?
AD bank and the seller of overseas tour package. We are going on a tourism, and you booked one. I selected one tourist and booked the tickets or flight tickets or food or travel expense, everything you booked as a package. That person has to collect the TCS. When bank has to collect, when the seller of tour package has to collect, we'll discuss now. So AD bank 206C1G provides liability to the AD bank when any person wants to remit any amount under the LR scheme, he needs to collect the tax of 5%. First of all, 5%. If it is up to 10 lakh rupees. If you are remitting up to 10 lakh rupees, you go to AD Bank, submit Form A2, saying that is the LRS remittance. Automatically, they will collect 5% extra. And if the amount is more than 10 lakh rupees, they will collect 20%. So there is a cap of 20%, which means you are remitting of 1 crore rupees to outside India under the LRS scheme. Only under the LRS scheme, being a resident individual wants to remit to outside India 1 crore rupees, they will collect 1 crore 20 lakhs rupees from your bank account. 1 lakh, 1 crore 20 lakhs, 1 crore they will give you in foreign exchange to your foreign bank account or your whatever purpose you want to remit. The 20 lakhs will be deposited in the government account against your PAN number. Next year, we need to, when you are filing the income tax return, you can claim that TCS. Like for TDS also, you can claim your TCS also. If there is no tax liability, that amount will be refunded. This section has been brought in order to discourage the foreign transactions. Simply in order to discourage the remittances under the LRS scheme, to preserve the forexes in India, they brought in this 261 under the income tax act. Earlier it is only 5%. Now it has become 20%. It is more than 10 lakh rupees.
So this is for the overseas tour packages even purchased in India from Indian.
Then that is also available.
Oh, thank you.
So that 5% when it is applicable, 10 lakhs when it is applicable. So if you're remitting to outside India for a loan education purpose, and the amount has been borrowed from any finance institutions, there is no TCS. Zero TCS, zero rate. We can remit up to 2 crore rupees without any extra TCS. And if you're remitting for overseas tour package up to 10 lakh rupees, we need to deduct, or they need to collect at the rate of 5%. More than 10 lakh rupees, they will collect 20%. If it is medical or education purpose, up to 10 lakh rupees, they will not collect.
Only if there's a tour package, then they have to collect.
Only tour package.
If we individually.
Individual up to 10 lakh, you can remit it without any problem. So more than 10 lakh rupees only, it is TCS.
So that's including credit card payment.
Credit card also will discuss that, because there are certain conditions applicable for the credit card payments that I will cover now.
If I am going abroad and I'm using credit card, then
Actually, in 2022 or somewhere in 23, it seems, in May 23, they have given one circular. RBI has given one circular stating that payment made through credit card also covered under the LR scheme. After 6 months, they have withdrawn that circular, stating that credit card payments are not covered under the LR scheme. So when you are not paying amount through credit card, LR scheme, automatically this section is not approved, which means we are making any payment through credit card in abroad, TCS will not be collected. But the idea of the government is to collect, include them, that also. They brought in that circular, they issued, after 6 months, they were withdrawn.
but if we are same thing, we are using the credit card to buy a package to ease my trip when we are abroad, then again, even if it's whatever amount they're charging TCS, they're adding that amount to the TCS billing, the limit of 10 lakhs.
Sorry?
Suppose I'm booking a room in some website, so I'm using my credit card. So whatever is the value of the room, that
By default, they might have included, sir, but
Yes.
Amount that they take for the exchange of.
no, suppose the room rent is 10,000. So the 10,000 is added to the permitted within the 10 lakhs limit. Per day, suppose 10,000 is a room rent. So that is being added to the LRS limit. So the 10 lakhs limit.
no, sir, that may be covered under the overseas tour package scheme.
Yeah, if you pay by credit card, you pay by NEFT or UPI.
No, sir, there are two.
Doesn't matter.
Again, we need to check two conditions. When you are going to AD bank only, LR scheme will come. If you are going to buy overseas tour package, whether it is LR scheme or not, automatically TCS will be collected.
Yeah.
Explain once again.
If you are going to bank to remit outside India, then only they will check whether the amount is remitted under the LR scheme or not. If you are going to overseas tour package or overseas tour package operator
and pays the amount. Automatically, without any limit, they will collect.
Okay.
Whether you make the payment from the credit card, debit card,
Okay.
bank remit, any bank remittance, they will collect TCS. Because section 260(1G says that AD banker has to collect if it is LRS. The second condition is if the overseas tour package if is buying it, I mean is selling that tour package to any resident in India, automatically TCS will be applicable. The only condition is that tour package should be outside India. There is a catch here. If you are booking the tickets or anything from a overseas person, non-resident, it doesn't have any business connection in India, automatically TCS is not applicable. So if you are booking the travel plan from Indian operator, the TCS is applicable. If the operator is a non-resident, for example, if you're booking in a US website, how does he knows that there is a 261G in India and he has to comply? There is no such compliance. So you can use that and book your tickets. So limits have been given in detail. These are the current existing rates. The previous it is not required because it is confusing. So when you are going to a bank and wants to remit amount from India to outside India, automatically they'll give a checklist of information. Submit form 15 CACB also they will ask. Don't even know what is form 15 CACB, but they'll ask bring that form 15 CA from a chartered accountant or CA from a chartered accountant, applying with form 15 CA, then only will remit the amount. So what is this form 15 CA and CB we need to discuss. It is not coming from the FEMA, it is coming from the Income Tax Act. FEMA doesn't say anything. You need to submit form 15 CACB. There is a FAQ under the LR scheme also, which provides. FEMA doesn't talk about form 15 CACB. If there is any other complaints from other act, please follow it. Income Tax Act requires the form 15 CACB. It is not from the FEMA, though it will be asked with the banks when you are remitting to outside. This is coming from the 195. We already discussed it. That when you are making payment to non-resident, we need to deduct tax under section 195 at the rate of 12.5%. The plan is not submitted 20%. There is subsection which provides that every person who is remitting to outside India or who is making payment outside India, he has to provide that information to the income tax department. That is what form 15 CACB means. I being a resident individual or the company wants to make the payment to non-resident or a foreign company for various purposes, whether it is taxable or not taxable, whether it is only part amount is taxable, whether it's taxable at the rate of 12% or 30%, I need to give that information to the income tax department. This is where the form 15 CA CB has come. Form 15 CA and CB are nothing but two parts, whereas form 15 CB is a certificate given by chartered accountant, whereas the form 15 CA contains four parts: part A, part B, part C, and part D. Part A is applicable if the amount is not taxable in India. Part B is applicable if the amount is less than 5 lakh. Part C is applicable if there is a requirement to obtain form 15 CB also. Those there are conditions are there. So this is coming from the Income Tax Act. So banks will ask you, even if you are remitting from your NRO account to NRE account, they'll ask. Practically speaking, as per the Income Tax Act, when you are making from NRO account to NRE account, form 15 CACB is not required to be filed. Because I being a non-resident or non-resident, from my NRO account, I'm making to my NRE account. Bank will ask for form 15 CACB. But whereas the Income Tax Act says that a person paying to non-resident then only submit the form 15 CACB. But the bank will ask, we need to give it.
Also ask for like,
Surprisingly, if being a resident individual, when I purchasing a property from a non-resident for 50 crore rupees in the earlier example, I need to remit that 45 crores to the third party NRO account. I'm making payment to non-resident. I need to file form 15 CACB.
But bank will not ask, because I'm not remitting to outside India, the bank will not bother. I'm making payment to non-resident NRO account in India. Still in this case also I need to file form 15 CAC because I'm making payment to non-resident. Maybe in India also. I need to file form 15 CACB under the Income Tax Act. Bank will not ask. Bank will ask when I'm making payment from my NRO account to my NRO account, because that amount is remitting to outside India or it is coming to a foreign currency account, automatically they'll ask.
So at the time of filing your income taxes, you will just go ahead and form.
No. At the time of remittance, they'll ask. Remittance.
You said nobody will ask, no bank will ask. It's
No.
going to an NRO account.
No. You are remitting from NRO account to NRE account, automatically they'll ask.
No, the other one, the other example. You just-
Nobody will file it practically.
Right,
Nobody will file it, but it is to be filed.
at the time of your income tax return.
No, ma'am. At the time.
From the resident Indian to the non-resident.
Who's asking, but it is your duty to file.
Yes.
Is that what you're saying? To the bank, again,
Not to the bank.
then.
It is the income tax department. It is the online form. Not at the time of filing income tax return. At the time of payment itself, you need to go to login on your e-filing account, submit the form.
Whenever the
Even when-
transaction is happening.
Yes, sir. When you are submitting to the bank, it doesn't mean that you are filing to the bank. You are filing to the income tax department and giving that form to the bank.
Got it.
In this case, I think, in addition to the 15 CSCB, they also ask for permanent residence certificate and all before, if you are renting to a person outside India, who is a non-resident.
Permanent residence.
I think tax is-
TRC, we are talking. TRC with the last, but depending upon the bank you go back. Some banks will not even ask form 15 CA, CB, they'll just go with the form 15 CA.
15 CA is 5 lakhs, about that you have.
The amount is not taxable.
5 lakhs is not tax, normally.
The amount is taxable.
If it is taxable, you have to file any. If it is not taxable, it is not more than 5 lakhs, then it is 15 CA is only.
It's only sufficient, but they still ask for form 15 CB also.
So what is all this 15 CA, sir? And already the A2 form is already there.
Form A2 is for the bank under the FEMA. It's for the remittances, whether it is LRS scheme, any remittance to outside India, we need to submit form A2. They'll ask for the form 15 CA CB also. It is an income tax form. It is like income tax return.
When is it applicable?
When you are making payment to non-resident. When a person paying to non-resident, it is applicable.
The FEMA and one is 15 CSCB form of the income tax.
When I'm sending online in income.
In online, nobody will ask.
Yes, sir.
Yes.
Don't mind. I have a question of, here half of the participants are chartered accountants, most very good, so humble request. So please
Definitely,
ask
sir.
me question of.
So. This is just a procedural thing when we need to file form 15 CACB and when it is applicable. Then I given the case studies also incorporating both LRS scheme and $1 million scheme under the FEMA and the income tax. There is a Mr. X who went abroad from India for purpose of employment outside India long back, maybe 4 years back, 5 years back, he went to outside India. Now, can we utilize the LRS provision for the remittance of funds? Automatically, we should not say it is yes or no, should go to the FEMA first, because we are remitting the amount. We are looking at the FEMA angle first. When you are remitting under the FEMA, we need to check whether it is a resident or non-resident first. So, if you went for the purpose of employment long term, automatically you will become a non-resident. Once you become a non-resident, LR scheme is not applicable. So he, after a long term, returned to India. After 4 years or 5 years, he has returned to India for again for the purpose of employment, and he continues to stay in India. Now he wants to remit the sale proceeds to outside India. After coming to India, he has transferred one property in India. Now he wants to remit to outside India. Which scheme is applicable? So now the LR scheme only should applicable, and the remittance of asset return should not be applicable here because he has become a resident under the FEMA. Once he has come to India for the purpose of employment, he will become a resident. That too after 4 years or 5 years, he is transferring property now. Now, once he become a resident, automatically LR scheme should come. The remittance of asset regulations will be applicable only if he is a non-resident. Once he become a resident, LRS scheme, 2 crore rupees. If he is residing outside India, automatically $1 million means. Now the third question, he went outside India for site visit, tourism purposes. And they spent amount through debit card and credit card. Now that amount is reckoned for the purpose of LRS. So we already discussed credit card payments. Maybe 3-4 months they covered under the LRS. Later on they removed or withdrawn that circular. So when you are making the payment through credit card, it will not come under the LRS scheme. So without any limit you can use. When you are making the payment through debit card, it will come under the LRS scheme. So the limit will be applicable.
How much amount you can do it? 1 crore, 2 crores.
Credit card. If they were card permits.
There's no control.
No, there is no, sir.
You come back, they will also.
So now the fourth question is, a student Mr. K has gone outside India for the purpose of education. Now can his father send him borrowed money from his bank in India? So there is a restriction only for the capital account transaction. This current account transaction, you can borrow amount from a bank and he can remit for his son education outside India under the LR scheme. Mr. A is a non-resident under FEMA. So it is already disclosed. Consider that he is a non-resident under FEMA. He has went outside India for employment or he stays less than 180 days in the previous year. He will become non-resident under FEMA. Now, he has acquired a property when he was a resident in India. He wants to transfer new property in India now. Whether the TDS under section 195 is applicable or not. We should not jump into the income tax again and say that it is applicable. Again, we need to check whether he is a resident or not. We already discussed that he is a non-resident under FEMA, but we need to check whether he is a resident or not under the Income Tax Act. He may become a resident under the Income Tax Act. If he becomes a resident, 195 is not applicable, though it is a remittance under the $1 million. TDS under section 195 is not applicable. So both are different. FEMA is different and the Income Tax Act is different. Under
Transfer
the
means sale, sir.
transfer is nothing but a sale. Previously, we discussed $1 million is applicable for a non-resident individual, and the LR scheme is applicable for the resident individual. And when making payment to a non-resident under the FEMA, $1 million scheme is applicable, and the remittance by a resident individual, $2.5 is the maximum limit which can be remitted. This is the under the FEMA, but the income tax we need to check the resident status again. If a person in this example is a non-resident under the FEMA and is transferred the property in India, automatically $1 million scheme will come. He can remit up to maximum of $1 million. It doesn't mean that TDS under section 195 is applicable. Though he is a non-resident, 195 may not be applicable. Because he is a non-resident under the FEMA. We need to check the resident status under the income tax. If he is a resident in India under the Income Tax Act and non-resident under the FEMA, he can remit $1 million and a TDS is not applicable. And the TCS is also not applicable because he is not remitting under the LR scheme. Because LR scheme is applicable to the resident individual under FEMA. Because he is a non-resident under the FEMA, that is also not applicable. In another case, Mr. A, resident in India under the FEMA and a non-resident under the Income Tax Act. Is a resident under the FEMA, which means LR scheme is applicable, but non-resident under the Income Tax Act. Now he wants to remit that amount. Once he become a resident under the FEMA, LR scheme will come. Maximum limit is 2 crore rupees, but he is a non-resident. Then automatically TDS under section 195 will come. So this is the interplay between the FEMA and the Income Tax Act. We need to check both. Just because you become a non-resident under FEMA, section 195 is applicable, 4.5% that is not the case. We need to check the resident status under the FEMA first. Then we need to go to the Income Tax Act. We need to check the resident status under the Income Tax Act. If he becomes non-resident under both scenarios, $1 million plus 195 is applicable. If you become both resident under the FEMA and
Income Tax Act, 2.5 billion, 2.5 lakh, and the LRS under, I mean, TCS under 261G is a.
Is there any restriction in the number of houses I can sell and take the rest of the
In India?
two houses?
Cannot. Yes, sir, there is a restriction. Actually, in respect of house, residential property cannot permit more than 12 properties. Annual limit is 2. The restriction is there.
Lifetime or per year?
Yeah. That limit is only for the year, ma'am. That $1 million you are talking about, is it only for 1 million?
But two houses is for lifetime.
Two houses, it is provided in the non-debt instrument rules 2019, doesn't specifically mentions for the year. Says that if you are remitting outside, say it is telling that you can remit if you are remitting from the investment is coming from outside India, and sale proceeds can be remitted outside subject to conditions. First condition is without any limit on farming. Without any limit, you can transfer remit outside India, subject to condition that it should come from outside India. If it is residential property, it should not be more than 2 houses. That's it. It means automatically it is.
And if you're not remitting outside, as many as you know.
If you are non-resident, if you want to keep the amount in India, nobody will ask.
Can I just ask again? If the amount is coming from outside India, and I am selling it, this two house restriction is applicable? Or for the.
Applicable. I am giving the one article also there in this session. There is a link in the article, you can just click and click after.
But if these houses are ancestral, then there is a limit of two is not.
It's not applicable. Right. If it is ancestral, automatically that will come under the remittance of expectations. $1 million scheme is applicable. Mr. R is a resident individual. He has gone outside India for holiday trip and arranged it under the package, overseas tour package. He has paid 3 lakh rupees for the holiday trip to a operator, overseas tour operator. He has paid 3 lakh rupees. Whether TCS is applicable? The answer is yes. TCS is applicable because it is of 3 lakh without any limit. When you are making payment to or you are buying any overseas tour package, 5% TCS is applicable. If it is less than 10 lakh, 20% is more than 10 lakh rupees. Instead of paying amount to overseas tour package, he himself arranged the tickets, the train tickets or the flight tickets, hotel, food expenses, then the TCS is not applicable when you are making amount to AD bank. Because up to 10 lakh rupees, TCS is 0. Up to more than 10 lakh rupees only TCS. Now the interesting question. He has paid 15 lakhs rupees to the overseas tour operator. The TCS will be applicable, 20% is he will collect. After 3-4 months, he himself has paid 3.5 lakh rupees for purchase of tickets, booking of hotels, and paid his food expenses on his own without arranging any overseas tour package. When the TCS is applicable to the second payment of 3.5 lakhs, the answer is no. Both are mutually separated, which are both are independent sections. The TCS under section 206C1G contains 2 separate links. One is for the payment to AD bank, and the one is through overseas tour package. Just because I paid 15 lakh rupees through a overseas tour package, my limit will not exist. That limit of 10 lakh rupees will not exist. The fourth question, if he doesn't have a business connection, I'm making the payment to a non-resident, a company residing in USA, and paid of 3 lakhs or 10 lakhs or 15 lakh rupees for overseas tour package. Whether there is any TCS applicable, the answer is no. When you're making payment to a overseas tour operator outside India, the TCS will not be applicable as a tour operator, but the AD bank will come into picture here. Because there is 2 links. AD bank has come. He will check whether you are purchasing any tour or overseas tour package. If you are purchasing for overseas tour package and the TC is collected by that person, AD bank will not question. But in this fourth example, you are making payment to a non-resident.
is not liable to collect any tax in India under 261G because he doesn't have any business connection in India as a overseas tour package operator. But you are remitting that amount to through a AD bank. So AD bank will question, there is a limit of 10 lakh rupees. Mr. B, a person being a resident, citizen of India, is a citizen. He is going abroad during the 24-25 in December 2024. He went abroad for the purpose of employment. Once the purpose is for the purpose of employment, he will become a non-resident under the FEMA. In January 2025, he has sold a movable property in India, which is acquired by inheritance. And he wishes to remit the sale proceeds to outside India. What are the conditions or what are the limits we need to check here? First, we need to check the resident status under the FEMA. Then we need to go to the resident status of the income tax side. He went to USA or any other country for the purpose of employment. So he will become a non-resident under the Foreign Exchange Management Act. From December 2024, he is a non-resident in India. So automatically my limit will come under the remittance of asset regulations of $1 million. Now I need to check the resident status under the income tax act here. So now he went to outside India in the month of December 2024, which means that he stays in India more than 182 days. He will become a resident in India under the income tax act. Once he become a resident under resident under the income tax act under section 6, this 195 is not applicable. Though he become a non-resident under FEMA, he will become a resident in India. 195 is not applicable.
Under income tax,
Yes.
for a year I'm either a resident or non-resident.
Yes.
Under FEMA, for part of the year I can be resident.
Yes, yes.
Here I'll be non.
Yes.
So regarding the status of the visa also, not as, suppose for Dubai and all, we can get tourist visa, but we can go and apply for work and convert it there. So, but then when we submit the IT return, they will ask that to show the stamping on the passport. Then they will consider in the visa is different than the passport stamp.
The
In
passport.
that case,
No.
in that case,
It doesn't
they will
matter,
be
sir.
considered as an employment or tourist, and then that status will be considered as a.
Income tax act says that already discussed. Number of days of stay in India is important. Doesn't matter what is the purpose you went outside India, what is the purpose you come to India.
For FEMA under these circumstances.
FEMA is different, sir.
Yeah, as per this FEMA, as per this more transfer of money from money received from sale of property. Under those circumstances, what happens?
You will become a resident under the income tax act first year. I'll complete this case study, then I'll come to it. So here the case study is not completed. So the third point, now he's transferring the property to a person in India. Automatically he'll get amount into NRO account because it is a remittance from the inheritance property. Automatically the sale process will come in park in the NRO account. He can remit only under the $1 million scheme. Right? $1 million scheme only can remit. Now we need to move to the income tax act. Whether buyer need to deduct any tax under section 195 or not. Because he is resident in India, I need not to deduct any tax under section 195 being a payer. Now he is remitting amount to outside India and from NRY account to NRA account in the same month or in the month of January or February. Under which scheme he can remit? Because he is a non-resident under FEMA, he can remit under the $1 million trust scheme. No TDS. Whether TCS will come under 206C1G, the answer is no. Because 206C1G comes only when you are remitting amount under the LRS scheme. So in this scenario, both TDS is not applicable and TCS is not applicable. So is a non-resident of FEMA and it becomes under the income tax act. So no TDS and no TCS, you can remit amount to outside India. But if he remits the amount in the next financial year, possibly you become a non-resident of income tax also, then it will. TDS is applicable if it is paid up in the next year. Now, a person named Mr. J, a citizen of India, has gone abroad one back. So automatically he will become non-resident under the FEMA. The first scenario. He returned to India for the purpose of employment during the year 24-25. So he will become a resident in India under FEMA. Now, his resident status from December 2024 is a resident in India under the Foreign Exchange Management Act. In January 2025, he has sold immovable property in India and wishes to remit sale proceeds of immovable property to outside India. Now we need to check what is the limit and TDS or TCS is available. Again, we need to start from the resident status under the FEMA. And for purpose of taxation, we need to check the resident status under the income tax. So we'll check the resident status under the FEMA first at the time of remittance, first sale, then remittance. Earlier, in point number 1, he is non-resident under FEMA. In point number 2, from December 2024, he has become resident in India. So automatically in point number 3, at the time of sale, he has become a resident under the Foreign Exchange Management Act. Now he is remitting the amount to outside India. The maximum limit is, because he has become a resident under the Foreign Exchange Management Act, LR scheme is applicable. So LR scheme he can remit up to 2 crore rupees maximum limit. Now we need to check the income tax. I am being the payer. I'm buyer or payer making amount of 2 crore rupees to this person, Mr. Jared. Now we need to check the resident status on the Income Tax Act also. He is residing outside India from long back, maybe 4 years or 5 years, whatever it is. He has come to India in the month of December, which means he is residing or stays in outside India is more than 180 days, which means he becomes a non-resident under income tax. Non-resident under the Income Tax Act. When we are non-resident under the income tax, we need to deduct the tax under section 195 also. Which means I am being a buyer and I'm making payment to Mr. Jet, need to deduct the tax at the rate of 12.5%. After deducting that payment, I'll make the balance amount into his NRY account. Now he wants to remit that amount outside India, under which scheme LR scheme will come. Once the LR scheme comes, automatically 261G also will come into picture. Again, TCS will be collected. In one hand, 195 will come into picture because I'm making the payment to non-resident under the Income Tax Act. TDS is coming and is remitting under the LR scheme as a resident under the FEMA. 261G also will come. So we need to check the resident status under income tax and the FEMA whether TDS is applicable or TCS is. In the previous example, both TDS and TCS is not applicable. In this example, both TDS and TCS is applicable.
Sir, once we transfer the money to the NRO account, why is that 2061G applicable? Already he has received the money, we have already deducted the TDS from him. Then why TCS come when he
TDS will come only when the resident making the payment to non-resident, sir. TCS will come when that person is remitting to outside India.
After getting money, he is transferring to his account.
How many times they want tax? That is what the most confused.
No,
Once they're collecting TDS, then
so
again
this is the practical scenario, sir. I want to club both two sections, 260-1G and 195, along with the $1 million and the LR scheme, both
Just
put
waste
together,
time.
four things into one example, like trying to keep. Hypothetical example, maybe, sometimes maybe practically also it is possible.
You may say it is two transactions.
Anyway, you are making the payment in the month of February, March. Immediately within 3-4 months, you can file the income tax return. If their amount is refundable, you can get it.
Previous example,
Yes, yes.
so there was no TDS and TCS.
Yes.
but, that person had to pay the tax in India, right? So we can visit.
Correct.
Just because TDS is not deducted, doesn't mean that the income is not taxable. The recipient has to pay tax in India. So one more example, we already discussed the interplay between the LRS and the $1 million scheme. the one with the 195 and the 206C1B. Now we are moving with the another example. This is a remittance by a corporate company. A company ABC Private Limited wants to make payment to outside India to a non-resident for royalty or FTS. This TDS under section 195 is applicable under section 195. So, for example, a company incorporated in India, private limited, is receiving or some services, some software services, or some consultancy services, some legal services, or it is getting a license from outside India, from either parent company or subsidiary company or fellow subsidiary company, whatever it is. Now, whether we need to check whether the 195 TDS and section 195 is applicable or not. So, in order to check that TDS and section 195 is not applicable or not, we need to check whether the amount is taxable in India or not. Whether it is FTS or royalty, dividend transaction, or the interest payment, etc. We need to check whether the amount we are making to outside India is taxable in India. If it is taxable in India, then only we need to deduct tax on the section 195. The amount is not taxable by virtue of various reasons. Maybe that income is not taxable by virtue of it doesn't have any business connection in India, doesn't permanent establishment in India, or that service is not covered under the makeable clause of BPWA between India and other countries. That amount is not taxable. Automatically, TDS is not applicable under section 195. So we are when we are making payment to non-resident. So this is the step we need to follow. First, determine the resident status under the income tax and the first FEMA first. Then you come to income tax. Once you determine the resident status under the FEMA and the income tax, and determine what is the purpose of your remittance. Whether it is for the LRS scheme, it will come under LRS scheme, or the remittance certifications, or your business purpose, you need to determine. Then check the taxability. If there is a tax liability, and you have not deducted the tax, and you made the payment to a non-resident, then income tax liability will be on you. Being an agent of non-resident, you will be considered an agent of non-resident. Being a payer, automatically entire tax will be collected from the payer. So the non-resident takes the full amount of 100 rupees or 10 crore rupees. The remaining tax amount or the full tax amount of 30% or 20% will be collected from the buyer. Being you are responsible person, you have to check the tax liability of the non-resident. You have to deduct. You are not deducted, you pay the total tax of that person in India. And you need to check the form, whether the form 15 CA CB is applicable, which part is applicable, whether the CA and the CB both are applicable, only part is applicable, you need to check. Then you go to the ID bank, submit form 15 CA CB, submit the invoice copies, submit the agreement copies if any, submit tax resident certificate if any, submit any other documents if required with the bank. Then you go to the for remittance. The amount will be remitted to outside India. So you were asking for this one? Or?
So, okay, sir, I'll ask you.
No problem. So, if any questions on this case studies or the two LRSP 195?
Yeah, another one.
Yes, sir.
See, one of the NRA received dollars in US. Later, in India, he wants to transfer in Indian rupees to the same person. Is
Okay.
that a valid transaction?
Non-resident received amount in
Dollars in the US,
okay.
the same person, and the same person having Indian account in India.
Yes, sir.
So they are transferring in Indian rupees. So they want to set up this transaction. Is that possible?
It is called.
No, you were sitting with the third party in India.
No. Mr. A in US has received funds from Mr. B. That is through banking fund.
Okay.
In India, A wants to repay to B in Indian rupees through banking fund.
No, sir.
No,
No, sir.
You cannot set up transactions outside India in India. No, sir, setting up is not allowed. When your liability in USA, you cannot set up in India.
Sir, hello,
Sir,
the proprietorship form is there. They want to register their trademarks in Malaysia and US. And they have to pay attorney fees. Along with the cost of registration in that country.
yes, sir.
So.
So it is
Say this is the practical scenario. This is $500. And as a payer, I go to bank. The bank will collect the tax. So that attorney will say that I have to receive $500. So that means I have to pay 500 total and pay the TCS separately from my pocket.
So in this scenario, first we need to check. There are two things we need to check. Sir. When we are making payment again to non-resident, we need to check whether the payment is taxable in India. Now to check our TDS liability under section 195. They are making like payment to attorney. Is it considered as a professional?
Yeah.
Independent professional.
He is not rendering any service here.
But I'll come to that point. Sir.
Yeah.
So there is a DTW between India and Malaysia. There is a separate article for the independent personal services. So if you are making to a person professional independent personal services for the purpose of any lawyer, teacher, engineer, accountant, these are the prescribed professions. When making the payment outside these type of persons, we need to check whether that person is having any base in India, number of days of that person in India. If he is residing in India more than 180 days, or if he has any fixed base in India, first we need to deduct tax in that from that account. In this scenario, you are telling that he doesn't have any connection in India and he doesn't have any business connection, fixed base in India. Fixed base is nothing but an office setup.
Yeah.
He doesn't have any. And his number of days of stay is not more than 180 days. He has not completed. Maybe other purpose also, not for avoiding your taxes. Automatically, it will be taxable only in the country of residence. In that country only it is taxable. So we need not to deduct any TDS under section 195. The second question is that question you are asking, sir. Under which scheme you are transferring amount from India to outside India? So if you are remitting under the LRS scheme, if the amount is remitted under the LRS scheme, being a sole proprietorship, you need to send the amount under the only LRS scheme. Automatically this has to be collected. Right? That amount is under the LRS.
So I have to pay additionally the TCS.
That will be refunded to you, sir. Whether you make filing the income tax and by you, to be adjusted against your tax. If there is no tax penalty, the amount will be. If the firm is making the payment, instead of you and
Come under LRS, or it is import of services.
generally it will come under the import of services, but you are sole proprietor.
So there are 2 points. He is the proprietor and $500 is not taxable under TCS. Second thing is whether the service where that person is providing is in Malaysia, he say. So there is no import of service. He is just paying LRS for service provided by a firm to him under LRS scheme.
Sorry, no, I'm telling that this amount is not taxable. That is what I'm telling.
So
One ninety is not.
he is saying whether it is import of service. It's not import of service because he's filing a case in a foreign court.
That is called that is what is considered as input of services.
But it's not done here now. That is
Still okay. It doesn't matter. Just because the service provider is outside India.
Connection with India, it will be considered as import of services as this is.
Yes, sir. It is considered. A company
He has never come.
This one is Mindspace company. Mindspace, sir. There are many software companies here. They never went to, or they will not go to US or UK or any other. They'll export from here to other countries. For example, take any building in Mindspace. They will file forms saying that these are the export of services. They'll claim GST exemptions. Whether these people are going to US.
that is software is exported, that is not considered under
No.
GST, sir. But that's what they are providing
No,
from
sir.
Malaysia is not a service which is procured in India or it's not
Service for
serviced in
Indian
India.
person. No, sir.
That
Yes.
LRS is separate. He's a proprietor, he's an individual. he's
No, I'm not,
Yeah.
no, I'm,
Especially in India.
sir, I'm not talking about the FEMA, sir. It is under the Income Tax Act. Doesn't,
How is income tax connected to DGFT, JDGFT, sir? It is totally different.
who is talking about DGFT here?
Then the import of services coming under JDGFT.
No. I'm talking about under the Income Tax Act, whether the fees is applicable for the services or not.
Applicable. Only applicable.
Why it is not applicable? If it is not a,
It's because he's a.
Let me tell you.
He's not a proprietor.
let me tell you. If it is not attorney, sir,
Catch here, there is a catch here.
sir, if it is not, sir, if it is not attorney services, if it is not attorney services, but you have received some,
Professional.
professional, it is a professional service. Attorney service is a professional.
This I am receiving, so he is doing that service abroad. So.
I'll come to one more point. If it is not yet professional services, attorney services, and you have taken other consultancy services, not from the professional, TDS will be come. You need to pay the tax in India, or you need to deduct the tax, because this tax will be there. Though he has not come to India, though the service is not provided in India, it is taxable in India under section,
195.
no, sir, TDS under section 195, it is taxable under section 917 of the
917.
917, 9 of the law, income tax.
Okay, sir, please proceed.
Any doubt, any questions, any?
For this, a proprietor can only incur not more than $2.5 lakh, even for a current account transaction, capital account transaction. For the business purpose and so.
Business purposes, they can.
This is
Like,
current
what
account
is
transaction.
remitted should not be under LRS.
And.
Please have chair.
That is also available in our article, sir. It will not come under the LR scheme only, but what do you call, the 2.5 is not applicable because it is import of service only. In that scenario, PCs also should not be deducted, collected by the bank. We are making.
At the end of the day, I should not be held liable under the income tax law.
That is our, that is the object of the person, sir.
See, paying or taking TDS or TCS is not the issue. I should not be a defaulter under the income tax provision.
No, if the TCS is not collected, it is not your default, sir. It is the banker default. TDS is your default. TCS is not our default. TCS will be collected with the bank. It is the responsibility of the AD bank to collect the TCS if it is under the LRC.
It's okay.
One more thing, you said $1 million, then you said 2 crores. I got confused with the 2 crores.
$1 million is nothing but 8 crore rupees, sir. 2 crore is nothing but LR scheme. $250,000.
Ah, 2 lakh.
Because I converted into Indian rupees, approximately 80 rupees per dollar. It is 2 crore rupees under the LR scheme.
On one hand, you are telling in dollars,
Ah,
and the other
yes,
you are
sir.
telling in rupees. So that is.
It is 8 crore and 2 crore, sir. 4 times of LR is
Little bit
1 million.
confusing in the minds of this audience.
That's right. Yes.
One more.
Yes, sure.
One more basic question, when you use current account and capital account is NRO? And current account is just, what is the, why do you keep saying current account, capital account? Because I understand it from the perspective of a nation, but
No.
not for an individual. I don't have What
No,
is it called a capital
No,
account?
for our discussion, there is no need to discuss capital and current account transaction for this seminar. Yes, gave the brief introduction, what is the capital account transaction and what is the current account transaction, what type of transactions allowed under the FEMA. See, for example, the remitting to capital account transactions generally prohibited. Unless it is explicitly allowed. Current account transaction is nothing but your business transaction now. It is freely allowed. Subject to certain limits, but certain restrictions.
Right.
So in order to distinguish between these two only, I just brought in. There is
So
no.
there is no capital account in terms of an individual, correct?
It is there. It is there. Individual asset is there.
Anything which you buy,
So
an asset which is yours is a capital asset.
no. That is not the capital account transaction.
Ah.
Capital account transaction means if the transaction alters any asset or liability outside India, that is the capital account.
Got it. Okay, that's, thanks.
Vice versa, if a non-resident is making any transaction in India which alters his assets or liabilities in India, that is a capital account transaction.
Got it, but it's not an actual bank
Ah.
account. It's
Doesn't mean that you persist.
understood,
You
understood.
just-
Now, I was very confused, like, oh.
What is the NRE account, sir?
NRE.
If it's a Indian bank which is in the foreign country, that is the next.
No, sir.
Yeah,
No, sir. NRE account is an Indian account only. When you become a non-resident, you can open an NRE account. You can remit amount from outside India to NRE account. When you are leaving India, you can remit that amount back to outside India without any limit.
And what is the O?
NRO is nothing but our savings account. You are having a savings account, you become non-resident, you'll be
So what is
considered
the
as NRO.
difference in both of?
No, it is done.
So this is the question.
Can I contribute to this question?
I'll-
NRO.
So now question answer.
Yeah.
Yes.
So NRO account is nothing but your savings account. Once you become it will become a designated as NRO account. That is the only change. NRE account, when you become a non-resident, you can open another account with the bank in order to bring foreign exchange from outside India to India.
And hold it as foreign.
It will be
I'll just contribute on your.
yes, sir.
NRE is a non-resident external account.
Hmm.
Only foreign remittances in the form of foreign currency only you can deposit and hold it in foreign currency.
You can hold it in foreign.
Foreign currency.
No, sir. Both are rupee account only, but the permissible credits are there. For NRO account, these are the permissible credits. NRE account, these are the permissible credits. Credits in the sense you can remit from outside India and you can take it back without any limit. Without $1 million, you can bring out. NRO account up to $1 million account you can remit. It is only our savings account. It's nothing but our savings account. NRO is nothing but our regular savings account. You will be
Taxation is when it's in the E account versus the O.
NRO account is nothing but our Indian account.